Good afternoon, everyone. Thank you for joining Corporate Connect featuring AIMS APAC REITs, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX. We will kick off today's webinar with a presentation by Mr. Jeff Howie, Market Strategist from SGX, on recent market highlights, followed by the corporate presentation by Mr. Russell Ng, Chief Executive Officer. We will then end off with a Q&A session. AIMS APAC REIT is a real estate investment trust listed on the main board of SGX since 2007. The principal investment objective of AA REIT is to invest in a diversified portfolio of high-quality income-producing logistics, business parks, and industrial real estate throughout Asia Pacific. Without further ado, can I now invite Mr. Jeff Howie to present, please? Jeff, over to you.
Thanks so much, Eileen. If you could also start my camera, that would be much appreciated. Just can't start it as of yet. Maybe we won't have the camera up, which would be fine. But as long, yeah, okay, video's on. Thank you so much, Eileen. Good afternoon, everybody. Just a very quick 15-minute overview. With so much happening in the stock market, we'll try and keep within the 15-minute time frame, and really looking forward to Russell's presentation with AIMS APAC REIT. Okay, so just very quickly, I wanted to give a very quick brief economic overview, given that we are coming to the end of the year very quickly, and we've seen our GDP this year in Singapore expect to grow between 3 and 4%, and that has really been lifted by the services economy. It's been lifted by domestic demand and regional reopenings, and I think we saw retail sales gain as much as 11.3% in the first 9 months of this year. However, looking forward, Singapore's GDP growth next year is expected to decelerate to below trend levels, and this is because of the 3 overarching themes of global growth, global trade, and global inflation. So global inflation is expected to persist and remain above trend next year at around 6.5% across the globe. Now, in Singapore, inflation is also expected to be in this vicinity next year. An extra 1% into that comes from the GST inclusion. But we've grown, our CPI headline has grown by 5.9% for the first 9 months of this year. So expect that vicinity of 5.5 to 6.5% next year, including the impact of the GST. Now, looking across the various sectors, growth continues to be uneven, albeit less uneven than we saw in 2021 and 2020. So you might recall back in 2020, local manufacturing really surprised Singapore with its resiliency during the toughest times, I should say, of COVID-19. Local manufacturing grew 7.3% in 2020, and industrial REITs at the same time were comparatively defensive, right from the end of 2019 through to the end of 2021, when global trade really outpaced global growth in 2020 and 2021, with manufacturing remained very largely resilient, I should say, with manufacturing remaining very resilient across the region over those 2 years, those full 2 years. We saw for those full 2 years, APAC industrial REITs, which are comprised of the likes of industrial parks, warehouses, depots, and so forth, they averaged 28% total returns over those 2 years during those resilient manufacturing years. And that's across the region. And then you look at all the APAC REITs across the region, and you take out that industrial component, those REITs that are investing in industrial properties, and those REITs, the remaining REITs, actually averaged a 4% decline in total return for the remaining APAC REITs. So really super important when you look at REITs to hone in on the different sectors, and particularly with, as we said, these 3 overarching drivers of growth, trade, and inflation, and fragmentation in many ways of global growth and a new drive towards regionalization. It creates a very dynamic market. So fluid market drivers, a dynamic marketplace, and I think one to really look into in this presentation is particularly AIMS APAC talking about trends, not just in Singapore, but also in Australia. This year, we've seen the manufacturing sector broadly in Singapore been impacted by inflation through higher input and transportation prices. And the growth slowdown in China has also weighed the industrial sector. And also we've had the downturn in the global electronics industry, in addition to a higher base rate last year. So what we've seen this year is Singapore's industrial production, while it was really strong in 2020 and 2021, it's grown at 3.9% this year. And that's predominantly because our industrial production in Singapore is 40% weighted to electronics, of which 4/5 of that 40% is actually contributed from semiconductors. So that's, as you can see, we've seen that deceleration. And also on the non-domestic oil front, we've seen exports to China recently decline significantly. The China export component of NODX declined 34% year on year in September after declining 18% year on year in August. So China's economy obviously remains a key variable to our trade, and NODX growth is also expected to weaken going into next year. I should also, there are some really interesting structural themes to take into next year. The IMF expect our trade partners in the ASEAN region to really enjoy strong recovery going into next year. And that's, of course, thanks to robust consumption, robust exports, and of course, robust services. The region will also take cues from the US tightening cycle, however, and that has the potential to drive more currency depreciation and thus bring in more inflation to the region. So really, in summary, just a quick 5-minute on the economic prognosis at the moment, the Singapore economy does continue to move forward unevenly with the persistent global inflation pressures, the slowdown in China, and of course, the Ukraine crisis. They continue to provide the broad market headwinds. And because of those headwinds, the macro risks on an economic basis are tilted to the downside next year. So that's kind of where we are now. And how the market has moved with that, our market has been incredibly forward-looking in the recent few years. So the economy's 400 billion Sing dollars, the stock market's 550 billion US dollars. Sorry, the economy is, what is it? The size of it is 400 billion Sing, sorry, let me just slow down. The economy size in Singapore is 400 billion US dollars, and the actual market capitalization of all the stocks listed in Singapore are 550 billion US dollars. So along with the resilient economy, the stock market, as represented by the STI, has been the most defensive advanced economy benchmark in the year to date, with a 4% total return versus a comparative decline of 18% for the FTSE Developed Index. Couple of reasons, three key reasons, or three key sub-themes of the STI that I think I would like to kind of remind the watchers and the listeners today that just as Singapore is a global financial hub, financial services are a crucial cornerstone to the Singapore stock market. The trio of DBS, OCBC, and UOB make up 20% of the total market cap of all our stocks listed on SGX, in addition to 20% of the day-to-day turnover, in addition to 40% of the STI. Now, by comparison, the FTSE Developed Index has, and in fact, really global stock market on a whole, has about 5% representation to banks. So banks have been more defensive in the year to date, and that has worked well in the favor of the STI based on the overall sector weightings. And because of these higher interest rates, last week we saw the three banks conclude their third quarter business updates. So DBS, OCBC, and UOB, they have reported a combined net interest income of 7.4 billion Sing dollars. That's up as much as 1.3 billion Sing dollars from the second quarter. And that's based on net interest income rising because of net interest margin expansions with the higher interest rates, and also the growth of actual trade as well. So the key component of net interest income is, of course, your net interest margins, but it's also the size of your loan book. And the three banks have continued to grow their loan books in line with that mid-single digit year-on-year guidance provided earlier in the year, and at the same time also reduce their non-performing loan ratios. So that's been a very important part of the STI's defensiveness, that comparatively stronger weight to banks, but also like the importance of trade to the Singapore economy. The STI does maintain very significant regional revenue reach. For the STI, 49% of the revenue is reported to Singapore, with 43% reported to Asia Pacific, excluding Singapore, and another 9% reported to the rest of the world. And if you look in the year to date, the STI's strongest stocks have been Yangzijiang Shipbuilding Holdings, Jardine Cycle and Carriage, and Sembcorp Industries. Now, Yangzijiang Shipbuilding Holdings is based in Jiangsu and has reached historical highs in their order book this year, while at the same time benefiting from the appreciation of the US dollar to the renminbi. Jardine Cycle and Carriage has a big auto distributor business in Indonesia, reporting 90% of its revenue to Indonesia, which has also seen a significant rebound in consumer growth. And at the same time, for Sembcorp Industries, Singapore makes up 60% of its revenue, which of course is also undergoing this big transformation of its portfolio from brown to renewable energy. So moving right along, I guess, so that was two reasons for the STI's significant outperformance to developed index so far this year. Quickly, the third reason, of course, is that that local microeconomic focus on improving shareholder or unit holder value by undergoing strategic transformations, making acquisitions, disposals to really increase the operational efficiency of the business. And that micro front, that efficient curve front, has also been a key factor in the outperformance of a number of stocks within the STI. So that's the three things I wanted to just remind everybody on the STI. But just I want to set the stage now for Russell as well, because very important presentation about to come up. Local and regional reopenings have been a key theme for the S-REITs in the first part of this year. The sector did continue to attract more than its fair share of investor activity. So the S-REIT sector, it makes up 10% of the total market cap, or the total market value of all stocks listed on the Singapore market, but they make up actually 20% of the day-to-day turnover. And that 10% contribution to market cap and 20% contribution to turnover is comparatively high as well. From a global perspective, going into this year, the global REIT market was some $2 trillion in market value. So that meant global REITs made up 2% of the value of the total market cap of all stocks listed across the world. Now, REITs have been in the US since the 1960s, and while they only make up a quarter or so of the 800 REITs across the world, US listed REITs make up 60 to 70% of the total market value of all REITs listed across the world. So US REITs and their relevant drivers do have a significant impact on the overall tide of fundamentals and valuations that are tied to the global REIT market. Here in Singapore, we have as many as 17 of our trusts exclusively invest in properties outside of Singapore, with 20 of the trusts investing in properties in both Singapore and outside Singapore, and just the remaining 3 investing purely in Singapore. So many global forces can be at play in the performance of these portfolios, property portfolios. So we have also wanted to mention 14 trusts that have properties in Australia. Fraser Logistics and Commercial Trust and AIMS APAC REIT currently hold the highest percentage of their property portfolio to Australia, which I think for AIMS APAC, and Russell will correct me if I'm wrong in the next presentation, but it should be 40% approximate exposure to Australia, 60% exposure to Singapore. Now, across the broader S-REIT sector, 80% of the trusts that own and manage overseas assets from across Asia Pacific, the US and Europe, make it one of the most international REIT markets. Of the 8 industrial REITs, there's just the one REIT which is exclusively listing in Singapore properties. And that's understandable given the trade, all the really crucial important part of trade in these industrial portfolios, whether it's warehouses, depots, or logistics centres. The trusts are also highly diversified across property types, with a nice balance in our REIT market across retail, industrial, office, and hospitality properties, in addition to the sector also maintaining REITs in specialized investing portfolios such as healthcare related assets, or of course the data centers. Now, as of the end of September, our average distribution yield of our REITs and property trusts stood at just above 7% at 7.2%, and that trumped the STI yield of 4.1%, the MAS 10-year benchmark bond yield of 3.5%, and of course, core inflation at 5.1% at that time. Now, despite the backdrop of the increasing rates, where the Singapore 10-year bond yields had increased something like 120 basis points in the first half of this year, the FTSE-ST REIT index was still offering a higher yield spread. In terms of debt levels within the sector, it remains the sector maintains an average gearing ratio, which of course represents in its most basic form total debt divided by total assets, an average gearing ratio of around 37%, which is lower than the regulatory limit of 50%. And for the REITs and trusts, a lower gearing ratio can indicate a greater capacity to undertake more debt when needed for future acquisitions, while a higher gearing ratio, of course, can lead to credit concerns and so forth during economic downturns. The sector also has, on average, secured 75% of their borrowings on fixed rates. And despite the challenges of the last 2.5 years, if you look at the proactive role that S-REITs have made in their capital management to increase unit holder value by divesting, by recycling, by acquiring properties, or in some cases even merging REITs, there's been quite a considerable amount of work done. Portfolio acquisitions, they can be funded not just through debt, but also secondary fundraisings here in Singapore, such as through placements and rights issues. And we saw close to half of the S-REITs listed on SGX last year announce asset acquisitions valued at more than 12 billion Singapore dollars in total purchase consideration. And that acquisition drive did continue this year. In fact, in the first 3 quarters of this year, I think we saw something like 18 S-REITs announce acquisitions in the vicinity of $7 billion. So just to sum up, I guess, for investors that are concerned on the ability as well for REITs to raise rents in line with inflation and with the outlook for decelerating growth, rental reversion is a useful metric to show how new leases, whether those new leases signed at higher or lower rental rates than before. Investors should also consider when the REIT tenants are due for rental renewal with the economic outlook, because there's likely to be a positive rental renewal. If there is likely to be a positive rental renewal, it can be better for short-term leases. But if not likely to be a positive rental renewal, then longer leases may be preferred, and that can be in instances such as where you see corporate belt tightening and so forth. So to that end, along with rental reversions, weighted average lease expiry is also a key metric used by the industry to measure the tenancy risk of a property that can take into account the tenant's area or income, and importantly, the remaining leases impact on that income and, of course, that floor size, that tenant area. So these are, I guess, some of the metrics that we're looking at more, or the industry seems to be looking at more going into next year. But as we said, growth continues to be uneven, super highly fluid. You have so many different aspects, particularly to this REIT market, that I think really has paid investors to look beyond the benchmarks, look beyond the FTSE EPRA REIT developed index, look beyond the FTSE-ST REIT index, segment the REIT markets up. You can easily do that due to the prevalence of international REITs and, as we said, the very strong balance between different properties that make up the overall S-REIT portfolio in Singapore. We have grown to be one of Asia's largest REIT and property trust markets. And as we said, one really, well, as I've said before, over and over, really important part of the development of the REIT market has been the highly proactive investor engagement of the REITs. So now actually would be a good time for me to shush up and let Russell present on AIMS APAC REIT. So thanks so much, Eileen. I'll mute, and I'm really looking forward to this next session. Thank you.
Thanks, Jeff. Up next, may I invite Mr. Russell Ng, Chief Executive Officer, to present his corporate presentation. Over to you, Mr. Ng.
Great. Thanks, Elaine. Thanks, Jeff. That was a really good backdrop as to how the REIT market has been performing. So look, really happy to present our presentation to the audience today. What I'd like to do is just give an overview of who we are. I think most of you may be familiar with our business, but I'd like to start from the beginning for the new viewers. So look, AIMS APAC REIT, or as we like to call it, AA REIT for short. Look, we are a diversified industrial REIT. We are sponsored by AIMS Financial Group, who is headquartered in Sydney, Australia. As mentioned earlier, we are invested across 4 sort of key subsectors: logistics and warehouse, which make up about close to 40% of our portfolio. Business park assets, really anchored by our 2 properties in Australia, they make up about close to 30%. We have our high tech, that's about 7% of our portfolio, and general light industrial, which makes up the balance. And just in terms of its usage, really the general light industrial caters, for the engineering, manufacturing type tenants. Typically in the high value added services, precision engineering, that really sort of services the high tech sector, technology, EVs, as well as robotics. High tech, that's sort of really catering towards our life science tenants. And business parks, this is really sort of catering towards our sort of national corporates, Optus and Woolworths, as their national headquarters. On the right, we do have a summary of our business. We own 29 properties with a total AUM of about $2.2 billion. Our portfolio occupancy is very healthy at 97.5%. Our portfolio which really sort of measures the average lease term across the portfolio, is at 4.8 years, amongst one of the highest when compared to the other industrial REITs. And we have over 200 tenants, and so this really provides the REIT with good diversity in terms of income profile. Now, I like this chart because this sort of takes a step back in terms of how sort of AIMS has evolved with this business. So AIMS Financial Group essentially took over the business. At the time it was the MacArthur Cook Industrial REIT. This is back in 2009. And at that time, the market cap for that platform was 60 million. And today the market cap has grown to just under $1 billion. And due to its sizing, we are included in several sort of key REIT indices, the APRA REIT and the MSCI indices, just to name a few. Now, the successful turnaround, and I would say the transformational growth of this REIT, was due to our really active asset management and disciplined acquisition strategy. So over that time, the REIT assets really grew from about $500 million to about $2.2 billion today. And then I think importantly, we have delivered a total return of close to 260%. Now, how do we achieve this? Really, over the past decade, if we look on the right, we had completed 6 development projects, 3 major asset enhancements, and we acquired 4 assets. Collectively, these 13 properties are valued at about $1.6 billion today, and really account for 72% of our portfolio by value. So we like to sort of call it, it's almost like a castle's foundation. We really sort of curated the portfolio and enhanced the current specs to a modern facility, and that's what's really helped us really achieve very healthy portfolio metrics. And so really in good and bad times, we'll be able to continue to attract good quality tenants on long lease terms. Now, when we look across the asset management scheme, we've really had a good sort of leasing and marketing team that has had an excellent track record in negotiating and securing tenants on long lease terms, really sort of maintaining high occupancy, as well as maintaining a high level of tenant retention. So really sort of securing these tenants on a second and third cycle basis. Looking across the first pie chart up top, as you can see, our portfolio is anchored by really 2 high quality Australian business park assets. Now these assets are leased to master tenants on long lease terms between 9 to 11 years, and also with annual rental step-ups. So really sort of gives the portfolio a very stable income flow. We do have one property in the high-tech space, and as I mentioned earlier, this is leased to a life science company called Illumina. And so they are really a leading sort of player in their field that were involved with the COVID assessment, helping to identify the DNA genome. And so they've really been in expansion mode since the COVID period. Now we do have a balanced lease term of about 7 years. We just signed a 10-year lease just not too long ago with annual rental step-ups as well. So together, the high tech and the business park segment make up about 37%. So really leased to long-term leases with annual rent escalations. And the other major component is the logistics and warehouse space, about 42%. And again, this is mostly comprising our modern ramp-up facility that has been in real high demand, particularly during COVID. On the bottom chart, we do have a balanced portfolio between what we call single tenant users and multi-tenanted properties. And so our single users, as I mentioned, really sort of major corporates which lease these properties on long-term leases. Over 80% of our master leases have an annual rental escalation embedded in the lease. And of the multi-tenanted properties, I would say about 2/3 of our of these tenants are in the warehouse space. And we like this space because typically what we see is the shorter leases allow us to sort of capture positive rent reversions. And we have been able to benefit from some mark to market due to the current sort of supply constraints in this segment. Now this slide really sort of gives us really a good summary of all the properties that we've been involved in from a redevelopment and asset enhancement perspective. So over the past decade, we have developed over 2.8 million square feet of space. Now, of the 6 development projects, 4 were purpose-built as modern ramp-up facilities, and 2 were also built for advanced manufacturing, as well as our distribution customers. In Singapore, we do have about 500,000 square feet of untapped plot ratio. So this really allows us to really sort of capitalize on future redevelopments of these assets, which we typically try and time towards the the expiry of the leases, should the tenants not seek to renew these leases. Now in Australia, we also have about 1.5 million square feet of untapped plot ratio for our recently acquired Woolworths acquisition. But again, this is more a longer term option, given that Woolworths has a current lease for about 10 years at the property. And I think lastly, when you look across our acquisition front, we have been very disciplined. Really over the past decade, we have only made 4 acquisitions. And so we've been very selective because really every asset that comes into the portfolio starts to form the foundation of our portfolio basis. So we first went overseas. We bought a 49% interest in Optus Centre in 2014. Now this asset has doubled in value. So today the property is almost worth close to about 714 million on a 100% basis. So an almost 2 times uplift. Now from 2019 to 2021, we also acquired several properties in the industrial warehouse space in Burleigh Heads, Australia. We bought a modern ramp-up facility in Singapore. And we also, as I mentioned, we bought a high-quality business park in Norwest Business Park in Australia last year. Now for the 3 Australian properties, these are leased to Optus, Woolworths and Boardriders, again, as their national headquarters on long lease terms. And 7 Bullen Street, this is a ramp-up facility in Singapore. Now it is within the Jurong Innovation Precinct, which is home to other data centers and other EV companies. And what we like about this property is it's built to a very high spec. It's leased to a really sort of major Japanese freight forwarding company, KWE. And what we like about it is KWE's underlying customers are typically in high value added industries such as pharma, healthcare, and also life sciences. Now, with that backdrop about our portfolio, I'd like to move on to our financial highlights for the first half of the year. So what we liked was, really despite the volatile period, we did post another set of steady financial results. Our gross revenue and our net property income grew by about 28% on a like-for-like basis over the last year. Now that rise in income was mainly due to our Woolworths acquisition, which we completed in November last year, as well as higher rental income and recoveries across our portfolio in Singapore. Now, when we exclude the one-off reversals from our COVID rental relief provisions in the first half of 2022 last year, Our total distribution in DPU this period rose by about 2.3% and 0.9% on a like-for-like basis. Our portfolio metrics continue to remain healthy and robust. As mentioned, occupancy is at 97.5%. I think one of the highest amongst our industrial REIT peers. Our WALE, which measures our average lease terms, at 4.8 years. Our retention rate, which again sort of measures how often our tenants renew with us, was at 85%. And I think also importantly, our portfolio valuation in local currency terms was slightly higher at 0.9%. And this is mainly due to higher rental incomes that we experience across the portfolio. On the capital management front, we've always remained very prudent and proactive in this regard. Our gearing now is at 36.5%. Excuse me. Our weighted average debt to maturity, which again measures the average maturity profiles, is at 3.5 years. And our current weighted average debt cost is about 3%. And importantly, in the current rising interest rate environment, 88% of our borrowings are currently on fixed rates. As mentioned earlier, our gross revenue in NPI, did see a very healthy year-on-year growth of about 28%. Borrowing costs also rose by about 45%, and this is mainly due to the additional debt utilized to fund the Woolworths acquisition, as well as some higher floating rates. As I mentioned earlier, the distribution on a like-for-like basis, was higher at 2.3% and 0.9% respectively. And also, when you look at our share of joint venture profits here, now for those that may not be familiar, this relates to our 49% investment in Optus Centre in Australia. And that year-on-year decrease was mainly due to a slight fall in revaluation for Optus Centre this year compared to last year. Looking across to our balance sheet, as at the end of 30th of September, our NAV was stable at about $1.40 per unit. As mentioned, our gearing is kept at a fairly resilient sort of level at 36.5%. And I think just to highlight here again that our average sort of fixed debt is at 88%. Again, it's extremely important, particularly with the rising rates at the moment. Now, we really like this slide, because I think this slide really sort of highlights where we are in our sort of debt maturing sort of cycle. We did hear of potential increases in rates that were coming through the system as late as last year. And so in October, we did refinance over $200 million worth of loan facilities. And also in May this year, we had also completed another $200 million of loan facilities. So really got ahead of the curve in terms of the rising rates. And as a result, we've got no near-term debt maturing in this financial year. We do have a very small tranche in FY24. That's about $30 million. And that can really be sort of refinanced from our existing $220 million undrawn committed lines and additional cash. Now, looking in the sort of center pie chart, as I mentioned, we do currently have about 65% of our loans in fixed rates, and we have 4 interest rate swaps that will really sort of crystallize over the course of this and next year, and that brings up our overall hedge ratio to about 88%. So it's really resilient in the current rising environment. And on the Forex side, we adopted a natural hedge strategy for our Australian investments. We have close to about 60%, 2/3 of our investment using local debt. And the portion that is distributed back to Singapore, we do hedge that using currency forwards on a rolling 12-month basis. Looking across our portfolio occupancy, again, we have been tracking a very high level of occupancy consistently, currently at 97.5%, which I would say is probably structurally full, just given the fact that we do have some multi-tenancies, and it's just natural that there will be some downtime between tenancies. But as you can see, our portfolio occupancy has consistently outperformed the JTC national average by between 3 to 7% over the last 2 years. Over this period, we did sign 47 leases, just representing 7% of our portfolio by area. We did report a positive 8% rental reversion for the first half year, 0.6% for the quarter. As you can see in that table here, a large part of that growth and reversion was coming from our logistics and warehouse segment. So we have still continued to see very, very good demand, strong demand, across all, not just from the 3PLs like your DHLs and your Schenkers, but across very industrialist and also downstream. So we do have customers also in the semicon industries that may be looking for space, looking for warehouse space to store some of their equipment. Now, what we also liked was, as you can see in the bottom left, there were some new sources of demand, not just from the logistics space, but also in our engineering and also electronics, consumer and retail products. So really diversified across the board. And looking to the right, what we like about this chart is you can see our lease expiry profile. And the light blue segment really represents the logistics and warehouse segment, which has really been experiencing double-digit rental reversions, over the past 3 or 4 quarters. And so what we like about this is when you look at most of our near-term expiries, they are typically in the warehouse space. That's because our warehouse customers, like your DHLs or your Schenkers, would typically sign an underlying contract with their customers between 2 to 5 years. And so we typically lock in the lease terms that match the underlying contract terms. And so we're probably about halfway through our current rental reversion cycle. So I think we probably have about another 1.5 years before the rest of the leases mark to market to the current sort of market rental rate. And again, I really like the slide. This shows really our top 10 tenants in our portfolio. More than 50% of our income coming from sort of leading global, regional, and local firms. Most of these tenants are really sort of leading household names in their respective industries. As you can see, our top 3 tenants, Woolworths, Optus, and Illumina, they have WALEs that range between almost 8 to 11 years. And the overall WALE for the top 10 tenants really range about 7 years. On the right side, again, we like this chart because it shows you the diversity of the trade sectors. And we think that these are really sort of defensive and resilient industries. Whether there's a recession or there's a crisis, people are still going to need telecommunication businesses. People are still going to spend money in supermarkets. And obviously life sciences and healthcare, are really sort of essential services. Portfolio valuation, as mentioned earlier, we did see a slight increase in local currency terms in terms of overall valuation. We didn't experience any cap rate movements over this period. That was largely due to transactions really sort of maintaining at current values. We haven't seen many deals complete with softening cap rates or discounted prices at this stage. But we are monitoring the market and seeing how that will pan out and impact on the overall portfolio value. Now, ESG is obviously a very topical point. We've always been very much focused on our ESG framework. But what we're very pleased to announce, at least over the quarter, we did spend close to a year discussing with various market participants. And we did eventually sign a new partnership with Singapore Power, SP Group, to deliver 40,500 megawatts of solar energy. And just in terms of the scale, that's enough to power 4,400 HDB flats, and it's enough to take away almost 6,500 cars from the road. So really a substantial solar energy output amongst probably one of the highest amongst all our REIT peers. We were also happy to achieve another BCA Green Mark Gold Plus for 7 Bullen, our asset that we acquired in October. And as a result of all these initiatives, we've been included in the iEdge OCBC Low Carbon Index. So again, really a recognition of our sort of movement and our achievement to date. But really, our ESG doesn't stop here. Solar energy is obviously key to improving our carbon reduction. But we are spending a lot more time looking at how do we sort of reduce the carbon across the portfolio, not just from solar, but by doing day-to-day initiatives, engaging with our tenants, and really thinking through a longer-term impact from a climate change perspective as well. So really, we are just at the start of that journey, but I think we're making good headwinds. And I guess looking towards the market outlook, I think Jeff has mentioned earlier, we are in an interesting environment where we're obviously in a high inflation environment. Most countries are continuously raising rates. We don't see that slowing down anytime in the near future. That being said, the industrial market we think is very resilient. Most of the sectors are really focused on high value industries, and really, this is translated to continued strong demand for good quality warehouse space, as well as our industrial facilities, which have experienced positive reversions of between 5 to 15% over the past 4 quarters. Now, demand for space in Australia also continues to be strong, predominantly in clusters and locations that are well connected and have good infrastructure. Fortunately for us, our Australian properties are all leased, master leased to strong corporates on lease terms of between 9 to 11 years. And so to recap, look, we think that there are really sort of 6 key investment merits we really want our audience to take away. We have a very long track record and sort of execution capability to really buy yield accretive acquisitions that form the bedrock of our portfolio. We've curated a portfolio of high quality assets. As I mentioned earlier, over 70% of the portfolio today have either been redeveloped by AIMS, they've been asset enhanced, or they've been acquired by the manager. And this has really resulted in a portfolio of good specifications. Thirdly, we've got a very resilient tenancy base with strong credit covenants. So as you can see earlier in the top 10 tenants, quite a number of our customers are really the leading names in their industries. Number 4, active lease management. Again, we've had a very good track record of always getting ahead of lease expiries. Again, we have achieved an occupancy of about 97 to 98%, consistently outperformed the national average. And we've also managed to achieve a very high retention rate of about 85%. Again, a reflection of the quality of the assets that we currently own. Number 5, this is probably key, particularly at this current moment. We do have a very prudent capital management strategy. And again, we have sort of took very proactive steps towards the end of last year to really get ahead of our loan maturities. So we don't have any near-term refinancing risk. We've got a small portion of around 30 million in the next financial year. And I think importantly, a big chunk of our interest rates are currently hedged up to 88%. And lastly, we do have a track record in asset enhancements and redevelopments. So whilst we have close to 500,000 square feet of untapped plot ratio, this is certainly something that we are exploring and thinking through. Our focus, particularly in this environment, is to really focusing on organic growth, sweating our assets to maximize the highest sort of rental growth within the portfolio. So I think that makes a lot of sense for us, particularly in this environment. Great.
Great. Thank you, Russell, for the business update. I'm definitely keen to know more about the company's business. We'll now come to the end of the session, which is the Q&A sessions. May I now invite Mr. Eric Lim, Head of Corporate Governance and Investors' Rights from SGX, to moderate the Q&A session. Participants, you may input your questions in the Q&A session. And for our Facebook audience, please click on the link in the description box to join. We'll try to answer as many questions as possible. Over to you, gentlemen.
A very good afternoon to everybody. Thank you, Russell, for the great presentation. I'm sure it's very informative to a lot of audience out there. They have some questions which already been answered by you, or maybe some questions which they need more information. So I think let's proceed to the questions. I think I can see some of these questions that has been submitted prior to this presentation. And also some of the questions that came online through Facebook and as well as through our Q&A. But I think broadly, some of these questions about a few broad categories. One is on the current performance of AA REIT. The other one is on the future outlook, which I think most of the investors are a bit concerned, given the risk out there in the market, And also, very importantly, is the ESG initiative. It's on top of everybody's mind, ESG, and they've been talking about it. Fund managers have been talking about it. Investors are talking about it. So I'll say a couple of questions on that. And last but not least is some question on DPU. What investors are expecting to get, moving forward from here, what they expect from AA REIT. So let's start with that first very broad question about performance. Well, I mean, out there, the risks out there, the Ukraine war, the rising interest rate in the States, China, Russia tensions, and so forth. And there's a lot of talk about a supply chain, disruptions. So the question was really about how does the supply chain impact the tenancy and occupancy of AA REIT's properties? This is one of the questions. Maybe you'd like to take that first?
Sure. Look, I think supply chain was obviously affected during COVID. And I think that sort of really made a lot of corporates rethink about how do we sort of manage just in time to just in case. I think that's obviously certainly something that we've seen as that trend. I guess looking across our portfolio, we have seen some, a couple of our tenants who've been stockpiling some of the essential goods with government. So we haven't seen these contracts sort of come away upon the expiry of those leases this year. They have renewed for a further term, a further 2 or 3 years. So I think that trend we are still seeing in the market. Now, if you look across our portfolio, we do have about 45% multi-tenancies. And again, the bulk of that are coming from the warehouse logistics segment. And most of these customers are actually serving underlying customers in various industries, which could be electronics, it could be life sciences, it could be healthcare, as well as essential services. So at this stage, we haven't seen a slowdown. I think it's also due to the fact that there is a current supply constraint. Even for us as REIT, as a REIT owner that has done quite a number of developments, we've been looking at potential development projects as well. What we've found is the cost to build in the current environment is also quite expensive. As a result, you don't get the rental rate that you would like to achieve, because ultimately that rental rate will be higher than market because of the elevated costs. And the elevated cost is due to really rising material construction costs. So what we see is we expect that the trend that we've seen, particularly over the last 4 quarters, to continue, predominantly for the warehouse logistics space. And again, we don't think that the supply chain at the moment is seeing much impact in our portfolio at the current moment.
Right. That is a good affirmation, Russell. I think the other question is really about the rising interest rates, and of course, REITs survive through borrowings, and you have a gearing towards that, So how this rising interest rate regime is going to impact AA REITs in terms of borrowing to refinance, to pay off the bondholders in future, your perpetual securities, and so forth. I think it's one of the major common concern among investors. How do you address that?
Sure. Look, I think as I mentioned earlier, we do have really sort of no near-term expiries on our loan tranches. So really, our next major expiry will come in FY25. So 2 financial periods away from us. So I think that's really going to drive some re-rating in terms of borrowing costs. We won't be having that sort of major impact on our portfolio until another 2 financial years from now. And I think in terms of our current loan portion, we do have up to 88% of our overall interest rates that are hedged. So that we think will help mitigate and cushion some of the rising rates. So really that's been our key strategy. We don't foresee any sort of major rises in rates having a major impact on our portfolio, just given the fact that we have no near-term expiries coming up.
Right. Thanks for that. I think there's one question from Facebook, and that is this person was asking about the capitalization rate of AA REIT's properties. Any comments on that?
Sure. Look, our cap rates, I think in our recent presentation, we had it on one of the slides, slide 17. And so that cap rates really sort of give you a range across the portfolio. So for our Singapore assets, you can see that the range is between 5.25% to 6.5%. For our Australian assets, it's ranging from 4.75% to 6.5%. So at the moment, we haven't seen any movement in the cap rates. And this is probably across the board because there hasn't been many transactions that have taken place, at a higher cap rate or higher yield at this moment. So at this stage, we don't see any sort of major movements, but obviously we are monitoring because ultimately, you know, a rising rate environment may have an impact on funding costs and therefore, you know, current yields expected from buyers. But at this point, we're not seeing any sort of major movements on cap rates.
Yes, I think that's great news to the investors and shareholders. And okay, let's talk about the future. Yeah, what the future? Have you touched a bit on the future outlook? Maybe some of the investors want to be a bit clearer, more clarity on what moving forward, how AA REIT is going to progress through the years in the future years. What is the outlook for the supply of new industrial space in the next 3 years? I think it's something that, you know, it looking at a crystal ball and looking forward to the next couple of 3 years, what is going to be like for AA REITs as well.
Sure. Look, I think if we look at where the market is, certainly at the moment there is that supply constraint across the board for logistics, for industrial properties generally. And we understand that JDC will be looking to increase some of the land allocations over the next 2 or 3 years. From what we can see in the current moment, most of the current supply that's coming on stream over the next 12 months are mostly pre-committed. And so a lot of these projects are actually allocated towards particularly manufacturers in the semicon industries. And so these are typically you know, multinational businesses that are looking to obviously set up that part of the business in Singapore. So look, it's very difficult to assess where we'll be in 3 years. Ultimately, from our perspective, really the focus for us is on organic growth. We have had a lot of success in the past. You know, as I mentioned, we had 6 redevelopments and 3 asset enhancements over the last decade. So we are still seeing some potential opportunities in the portfolio. And so this may come, typically you need some time to really sort of put together the transaction. But we are working towards opportunities you know, over the next financial year. But there are some near-term you know, organic growth that we can achieve really by just improving some of our amenities and really sort of just, you know, being proactive and driving the leasing discussions with our customers. There's probably only, I would say, one opportunity where we're talking to a potential prospect that may be looking to take over an entire building rather than just leasing up to multi-tenancies. And if that was to happen, it will be a long-term lease and it will be also at a, you know, hopefully attractive rent. But all these strategies are things that we've done in the past, and we are looking to emulate that concept at least in the near term. We don't think acquisitions are likely to occur. We just think that rising interest rates just make it very difficult to assess the underlying funding costs and therefore the overall DPU accretion. But we are remaining opportunistic. So we are still talking to bankers, agents, you know, vendors on the ground in Australia and Singapore, and just to understand where these, you know, vendors' expectations are. Because sometimes when you engage vendors today, we're not going with the pretext of doing a deal tomorrow, but we might get a phone call 6 months from now, you know, 9 months from now, you know, asking whether we're looking to do an off-market transaction. So we are still, you know, monitoring the market, but we are very disciplined in terms of how we approach our growth.
Right. I think prudent is the word. I think is that, you know, in terms of risk and returns and so forth. And I think you're always on the lookout for acquisitions wherever the opportunity comes around. So that's very good news to unit holders as well. So what will you think will be a priority in terms where your next acquisition will be if that happens? Will it be in Australia or in Singapore?
Yeah.
Which one is the more likely to happen?
I would say, look, both markets are of equal importance. Singapore is really our home market. And so we're really on the ground and we hear of every deals that do come through. Look, it's going to be really, you know, based on the risk-adjusted metrics, because what we find is Australia obviously has freehold assets, Singapore has leasehold assets. And so you do get a slightly higher spread. Australia, you do get typically 3 to 4% rental escalations. Singapore, it's usually flat, but you can sort of play the mark to market on shorter lease terms. And there are some transactions that we've done, obviously, we do have a 2% annual escalation. So my answer to that is, look, we're opportunistic. I think if the right asset comes to us and it is DPU accretive, and it has a good corporate tenant that, you know, may want to lease the property for 5 to 10 years with a rental step up, then certainly we will look at both markets with open arms. What we've seen also with our Australian properties, we've also been fortunate because the last property that we did with Woolworths acquisition, that was a large transaction. But what actually tipped it over the line for us, for example, is that had not only a 10-year lease to Woolworths, but that property was had a total gross floor area of about 44,000 square meters. And you can actually increase the total floor area to about 180,000 square meters. You can almost 4 times the total area. And so we like the fact that you've got this very good, strong corporate on a long lease term with five-year options, but you also have the longer term optionality of redeveloping that site potentially in the future. And when you see you have the Reserve Bank of Australia data center next door, you've got Commonwealth Bank of Australia data center next door, we like those options. So something like that, I think Australia offers interesting opportunities. In Singapore, we've done obviously Bullen, 7 Bullen, which is a good quality asset. And we've also looked at other deals that we've announced in the past with very good lease terms and some potential value enhancement on the properties.
Yes, thank you, Russell, for that. I think there is a question on ESG. Seems to be on everybody's mind as well about ESG is the big thing. I think with the government coming out to say we need better disclosure, more disclosure on what companies are doing on the ESG front. What is the roadmap for AA REIT moving forward to in terms of more initiatives, and what are the things we can look at from AA REITs in the coming years?
Sure. But again, this is a very important aspect for us. So in addition to the solar project, we are looking at the broader holistic framework that will cover things like environmental, social. Social covers our employees, it covers the communities, it covers other stakeholders, and the governance component, which is the disclosure. So we are working through at the moment a carbon reduction roadmap, which we hoped to come out at the necessary time, just to give to let our stakeholders know where we're trying to move towards. We're also spending time looking at climate scenarios and thinking what should we do today to our portfolio to future-proof our assets. So it's certainly something that we're very concerned about. When we look at new acquisitions, including the one in Australia, we also had a particular segment of our report focusing on climate change and whether that asset would have any potential impact over the next 10, 20, 30 years from today. So what we are doing, we are working through this framework. It is still very much a work in progress. We are looking at the GRI principles and seeing how we can really adopt all these principles, everything from diversity to employee engagement to community engagement. So once we have this framework in place, we will be looking to come out with an updated sustainability report, which highlights our current roadmap. So that was really a work in progress, and should be available over the next whether it's this or next financial period.
Great news, great things, and I think the unit holders are looking forward to that. More things to come from AA REITs. That's great. Last but not least, let's move on to the DPU. I think AA REITs have given a very generous 4.7 cents of DPU, and it's very consistent over the years. So, the question is really, does unit holders expect a higher DPU in the future? Better things to come from AA REITs? What do you think?
That's a great question, which I would love to answer. Unfortunately, we don't give forward for future forecasts. I guess what I would say is when you look at our current last few quarters, and you see the portfolio metrics, the occupancy level, the WALE, the current interest rate, hedge ratios, I would say that probably gives you a good sense of our performance and potentially where we might be moving towards. And I think just to end off with that, we are still seeing reasonably good demand from our logistics and warehouse customers, which form the bulk of our expiries. So hopefully that gives your audience really a flavor of what is to come, rather than sort of giving a really sort of definitive DPU forecast.
Right. Just question just popped up about China. What is the plans for China? Because I know China is a doldrums right now, but a recovery could be around the corner. I don't know. I mean, everybody's mind that China can recover. So what is AA REIT's thoughts on that, on China?
Sure. We haven't invested in China. It is a market that our sponsor, obviously is familiar with. So look, very hard to comment from our REIT perspective because it's not a market currently of focus. But I think what Jeff mentioned earlier, it is, China is obviously a key market in this region. If and when they do open up their borders, we think there's going to be a quick rebound as well. That's my personal view. And I think that rebound in terms of activity will then sort of flow through, trade flows between China and the rest of the world, particularly around Southeast Asia. So it is obviously a market that will have a fairly substantial impact on this region, and we think that we're well placed to capitalize on that improvement, on that trade uplift across our particular portfolio. So Eric, I think you're on mute.
Sorry about that. Thank you so much, Russell, for answering some of the questions. And in fact, most of the questions. And then I think that, great job on the presentation. And we hope to see you again and hear good things from AA REITs in the future. Yes.
Look, thank you for hosting this afternoon's presentation. If anyone needs any more information, please reach out to us directly.
Thank you so much, Russell.
Great. Thanks, Eric. Thanks, Elaine.
Thank you, panelists, for the insightful sharing and also questions that came through. We have come to the end of the session, and in case you missed any part of today's session, you can rewatch the webinar on SIA's YouTube or on Facebook. Do visit our SIA's website to get updates on the upcoming investors education programs, as well as if you have any more further questions, do reach out to AA REIT's IR department. I'm sure they would be pleased to answer more questions that you may have. And here's wishing everyone to have a lovely lunch for the rest of the afternoon. Thank you and have a nice day. Bye.